Welcome to Market Call. I'm Marella Fernandez. Brian Madden on the show today, Chief Investment Officer, First Avenue Investment Counsel. He's going to take your questions on North American equities. Here's how to reach us. If you have a question, call us toll free, 1-855-326-6266. You can also email your questions to marketcall@bnnbloomberg.ca. Brian, thanks for coming in. A few more social media posts from the American president today, rocketing things up a little bit at threats to the EU and Apple. Do you sort of tune out the noise at this point, or what are you doing with this kind of information?
Well, it's difficult to tune it out, Marella.
It's pretty loud.
It's pervasive and loud and global. So, we don't strictly speaking tune it out, but we are resolute, our team at First Avenue Investment Counsel, in our commitment not to trade and react in knee-jerk fashion to these incoming executive orders and tweets and threats, because time and again in Trump 2.0 and Trump 1.0, we've come to learn that the playbook is, big bully bluff bets and then their walk back. So, the risk as an investor to trading on what is a pretty steady stream of reliably unreliable information, the White House being the largest global exporter of such misinformation in the last few months, is the risk of being whipsawed, and the market action in the wake of Liberation Day, or Liquidation Day, as it's maybe more appropriately known, is a great case in point. So, we've made some fine-tuning and some tweaks within our portfolios, but we've not made radical changes. And, we tend to fade a lot of these things as we see them coming in because, as I say, they are often walk back.
Retail numbers are also coming in for March. They are higher. Do you see this? And it was autos, I guess, that generally pushed that up. Do you see this generally as the buy ahead of tariffs coming in from people?
Probably, yeah. We saw quite a lot of that. In fact, the United States had a negative print for their gross domestic product, or the measure of their overall economic output, in the first quarter, and a lot of that was due to a massive surge in imports. In fact, the United States recorded its largest trade deficit in history in the months coming into these tariffs coming into effect. So, I think households were, let's say, stocking the pantry, and corporates were stocking the warehouses, getting items onshore before tariffs at whatever level were imposed. So I think we're still seeing the tail of that.
Let me ask you what you're seeing with earnings so far.
Yeah, they're looking pretty good, Marella. And so this is the real conundrum for investors. There's what we call hard data, which my colleague Kash Pashutin talked about on the street a few weeks ago. And the hard data is things like employment and retail sales and GDP and so on, things that are measured officially by government agencies. So for the most part, the hard data is coming in just fine. It's signaling ongoing economic expansion. But on the other hand, that's backward-looking, so investors will often rely on forward-looking or soft data from surveys of households or corporate executives, or the purchasing manager indices would be another good example. And those are coming in very squishy and soft, not surprisingly given the noise of trade, tariff, and policy confusion. But as it relates to earnings specifically, both in Canada and in the United States, we've seen really largely the bulk of U.S. earnings reports come in, and in Canada we're just really waiting on the banks to round out the constituents of the TSX composite, and we'll see that in the next week. But for the most part, earnings are coming in, pretty decently, showing growth year over year at a high single-digit, or in some cases low double-digit pace. So far so good. We'll see what the second quarter looks like. We are seeing analysts, so the bottom-up consensus of analysts forecasting earnings for Canadian and U.S. companies, really ratcheting down their growth expectations for the remainder of this year, such that we're now seeing consensus estimates forecasting 6 or 7% earnings growth for the S&P 500 and for the TSX composite, and that has really come down a lot from 12 or 13% coming into 2025.
Okay. We do have to take a quick break. We're going to line up some phone calls for Brian Madden, Chief Investment Officer, First Avenue Investment Counsel. Here's how to reach us. He's taking your questions on North American equities. We're back in a moment. back to Market Call. We have Brian Madden here. We want to get a question in first from Val. Val says, I would like to know Brian's thoughts on TMO, Thermo Fisher. Let's have a look at that chart as we talk.
Thanks for the question, Val. So this is not a company that we own in either of our two equity mandates at First Avenue Investment Counsel. Not one we'd be particularly inclined to buy at this time. The company, for those who don't know it, is a very large supplier of medical equipment and appliances, reagents, consumables, selling into biotechs and pharmaceuticals and laboratories. As we can see from the chart on the screen there, the stock has not been trading particularly well. And, I think there's sort of two factors to consider here. One is, as you might imagine, COVID was rocket fuel for this company's business. Earnings grew from about $13 a share in 2019 to something like $20 or $21. So way, way above their long-term sort of sustainable, normal organic growth rates. However, it set up a sequence of pretty difficult comparisons, and earnings have been stagnant to slightly down in the ensuing 3-4 years since COVID. Beyond that, we're seeing a lot of noise out of the U.S. administration about cutting funding for scientific research, the National Institute of Health being one such agency. Cuts to university funding, some louder than others, and various things of that sort. So to the extent research funding is not flowing to laboratories and funding its way into principal investigator accounts and some of these small biotechs that are doing primary research, that's going to have a knock-on effect for a supplier to those labs like Thermo Fisher. And then secondly, not to be forgotten, this is a company that is large. It's a $150 billion market cap, domiciled in the United States, but 50% of the business is global export sales. So to the extent, we have this ongoing trade saber rattling, and the U.S. is tariffing countries heavily. European Union, just as one example, escalating again today. So Europe is going to retaliate, and so some of these instruments and supplies and services coming into Europe are likely going to face retaliatory tariffs. So two sorts of sets of dark clouds that would sort of dampen our enthusiasm for this one. So not one we'd buy right now.
Got it. Let's go to the phone lines. Roger's on the line from Markham, Ontario. Hi, Roger.
Yes, good afternoon. Thank you for taking the call. Brian, what are your current thoughts on United Health Group, and would you give it a buy, hold, or sell at this point? Thank you.
Thank you, Roger. So this one is really timely. Obviously, it has come under quite a lot of pressure in this past month or two. We own it. We'd continue to buy it. In fact, we have bought it on weakness in recent weeks. So for those who don't know, this is the largest healthcare company in the United States of America. It's operating really in two different segments. Upstream, there's a health insurance business covering about 51 million insured lives through commercial plans, and then Medicare, Medicare Advantage, and Medicaid coverage for those populations as well. And then downstream of that, there's a managed care business and a pharmacy benefits management business. So recall, this is the company where, tragically, when they hosted their investor day in New York in December, their number 2 executive was assassinated by an individual, with an axe to grind. I won't belabor that story other than to acknowledge, how tragic it was. And it did expose some of the vitriol Americans, feel, or animosity towards their healthcare insurers. And so the stock wobbled a bit and then clawed back all those losses coming into April. They reported their first quarter results. They had, for this company, what was a very rare miss of about 1% relative to street expectations. They lowered their guidance for the remainder of fiscal 2025, citing some, let's call it, adverse selection with some new members they'd onboarded in their Medicare Advantage plans, such that their medical loss ratios were expected to be elevated for a few quarters. We expect they'll recoup that cost or claims pressure when they reprice and reset the premiums in 2026. And so the stock sold off pretty heavily on that. And then just a week or two ago, There was the unexpected departure or perhaps ouster of the CEO with the chairman of the board stepping in. That really rattled investors alongside the company pulling altogether their guidance for fiscal 2025. So indicative of just ongoing uncertainty and poor visibility on what their claims experience is going to be. And then finally, there was, as yet, an unconfirmed story surfaced by the Wall Street Journal that the Department of Justice might be investigating them for potential Medicare fraud. So none of these things are particularly good. And so we'd acknowledge that the brand here has been tarnished, but not irreparably so, we don't think. The stock is sort of traded off about 50%. And we think that is too much in light of what the company continues to assert their long-term sustainable growth rate is, about 13 to 16%. And when we see the shares trading at 12 or 13 times earnings, we just think the market has overreacted. The shares are undervalued. It continues to be the largest healthcare company in the U.S. And remember, healthcare is a sector that is secularly advantaged by demographics and morbidity trends in the United States. So, we think that they will regain the confidence of investors, but we don't think it's going to be an immediate fix, but we think it's worth the wait.
All right, we do have to leave it there. We're going to line up some more calls for Brian Madden. When we come back, here's how to reach us. Stay tuned. Welcome back. Let's get to the phone lines. Ross has been holding on the line from Windsor, Ontario. Hi, Ross.
Hi, thanks for taking my call. I'd like Brian's opinion on Berkshire Hathaway. I know they've been hoarding up a big pile of cash, and his thoughts about the retirement of Warren Buffett also. Great.
Thanks for the question. So this is a very expensive stock, and there were some questions about his retirement by the end of the year, but he really has somebody stepping into his shoes sort of full.
That's right, he does. And so, we can say this is an expensive stock, and so that's always been the case, but expensive in price terms or expensive in valuation terms is really the key point of concern for investors. And I would say the piece about expensive in price terms is less and less relevant these days because you can actually buy fractional shares through some of the discount brokerage platforms. But even before that, Berkshire tried to alleviate that problem by listing these Class B shares, which trade at a fraction of what the A shares trade at. So, casting that aside, is it a good investment? Yeah, we think it is. Yes, Warren Buffett is retiring. Yes, he will be missed. Yes, many of us over the course of long careers, not as long as his, of course, have learned a lot of valuable lessons about investing from him that are timeless. But I think Berkshire has done a great job, and not every company excels at this, of planning succession well and setting up governance well so that the successor will be able to step into admittedly very big shoes. And so Greg Abel, Canadian, if I'm not mistaken, actually taking over the reins has been a number of years in the making. And I think if he's got the endorsement of Warren Buffett, that's good enough for us. So we don't own this stock, but it is a company we'd be quite comfortable owning. In some ways, it's doing what we're trying to do in our own portfolios, which is particularly our dividend growers mandate, which is put together a collection of businesses that are robust and resilient and that have wide competitive moats around them, very high structural profitability advantages, and a demonstrated history of generating free cash flow and in many instances paying out dividends and an ongoing ability to continue paying them. Berkshire itself is not particularly noted for dividends, but many of the companies in this conglomerate or collection of businesses are tremendously cash generative. And as to the $300 or so billion they've amassed as a stockpile of cash, I was asked about this on another outlet recently, and the question was put, if Buffett's collecting cash, should we all be scared and do the same thing? And I would say, let's not read too much into it. This is a company that likes to be cash rich because they like to be the buyer of first resort and last resort when there's blood in the streets and distress, and they're willing to wait sometimes years to be patient to write the big checks when once in a lifetime opportunities come along. So, I think today's as good a day as any to buy this stock, even though we don't ourselves own it.
Got it. Let's go back to the phone lines. Andre's on the line from Chilliwack with a question. Hi, Andre.
Oh, good morning, Morella. How are you? Thanks for taking my call. Brian, thanks for coming in. I just have a very quick two-part question. Could I get your thoughts, please, on the TSX hitting 26K in amongst all this trade and embargo rumors? Could I get your comments on that? And where do you think it's going? Higher? And could I get your thoughts maybe on the Nutrien? Do you own it? And would you continue to buy it at this level? Thanks, you guys. A good weekend to both of you.
Thanks very much, Andre. Okay, so let's start with the TSX, which did hit 3 record closes, sort of end of last week, start of this week, and then started trailing off from there. But what do you make of it? Because it seems like an odd time for it to be scaling higher.
Yeah, I mean, it's an interesting question, and thank you for those questions, Andre. So the TSX hitting record highs, we're pleased to see that. We're obviously invested extensively in Canada, and we think it's going higher. There's been, an American exceptionalism trade on for more than a decade. Maybe some of the luster's coming off of that trade and is returning capitals flowing to other regions of the world, including Canada. Let's not forget Canada is uniquely advantaged by having probably one of the largest index weights in gold of any developed market in the world. And gold has been doing very, very well. We're well exposed to that. So we think that and a number of other factors under the hood advantage Canada, not the least of which is still a wide disparity in valuation between our market and the U.S. market. Turning to Nutrien, we own it, recently added to the portfolio, January, I believe. We think it has got a long way to climb back, maybe not necessarily all the way back to the 2022 peaks, but this is a company that produces in its 3 upstream segments, nitrogen fertilizers and mines potash and phosphates. Prices of all 3 of those commodities are rising amidst a backdrop of improving slowly in some cases, but definitely demonstrably so, improving prices for the major agricultural cash crops planted in the U.S. and other regions of the world. So in the U.S., that'd be corn, wheat, and soybeans. It's a company that is discounted in valuation terms. The dividend yield is about 3.7 or 3.8%. That's above its long-run average. It's also prolifically buying back shares. It's bought back, I think, 25 or 30% of them since the amalgamation of the 2 predecessor companies in 2018. And there's a margin improvement story underway, turning around an underperforming geographical region in South America. So a lot of good things happening here, and we like the chart. It's turning the corner, having bottomed last summer, and a lot of upside, we think.
Okay, so just for note, you bought it, I think you said at the start of the year, in the $60 range?
Low 70s, low to mid 70s.
Got it. Moved up to 81 now.
Low 80s now.
Got it. Okay, we do have to take another quick break. When we come back, we'll have a look at Brian's past picks. We're back in a moment. Welcome back. Let's take a look at past picks from Brian. Last year, May 10th, here's what he chose. TC Energy was the first one, recommended at 52.78. Today up to 68.43, so 42% upside return of 50% total return. And this is a company, of course, that manages oil and gas, energy infrastructure. What have they been doing right for the past year?
Yeah, this is a really interesting one, Morella. I'd love to say that that's because the company just knocked it out of the park and had phenomenal improvement in operating results, but that's not what happened here. Our belief going in was that the catalyst that was pending late last year was the spin-off of South Bow, which was their oil pipelines, such that the remaining businesses within TC Energy would be quote-unquote clean. more ESG friendly. And so one of the best free lunches in investing is picking off the behavioral biases and sort of structural impediments to realizing performance that other investors may have. And so our belief was that with the separation of the gas pipelines and the renewables and nuclear power generation business from the oil pipeline, there'd be a natural sort of set of hands that both businesses would fall into. The ESG mandates could, in good conscience, load up on TC Energy. It looks like they did. And those that were agnostic to ESG considerations could load up on this quote-unquote dirty oil pipeline in South Bow. They did that as well, and it re-rated post the spinoff. So, a nice value lift here. So we continue to own like this one.
Got it. Let's move to your next pick from last year, May 10th of 2024, Agnico Eagle on the TSX. We'll have a look at where you recommended it at 93.53, and now up to 161.09, so a 72% upside return, a 75% total return. What were you looking at do you remember what you were looking at when you recommended it?
Yeah, absolutely. We were bullish on gold. We continue to be bullish on gold. We continue to own this stock, although we did take partial profits on it a couple of days before it reported its first quarter results in the low 170s. And we also, at the company specific level, had a lot of confidence in the assets, which are all domiciled in low political risk jurisdictions in Canada, Mexico, Finland, and Australia. Very diversified across 12 operating mines with good brownfields exploration upside at many of them. They own two of the biggest gold mines in Canada, for instance, and plan to increase throughput at those, among other initiatives. And just a very good, competent management team that has a history of meeting their numbers and their guidance. So, it is all that and more today because the gold price is some $1,000 higher, and that's been really what's been the major thrust behind it.
You mentioned you trimmed. Of course, it hit the record highs a couple of weeks ago, and you're holding on to it. You feel like you might trim it again, or do you feel like it's going to go even higher?
No, really, we were just sort of making a decision to manage idiosyncratic risk in our portfolios. So, we don't want to be a victim of our own success and have one stock take up, for instance, 10% of the portfolio. So what we actually did is trimmed it and waited a few days. Gold prices pulled back, and we rolled the proceeds into another mid-tier producer. So, it was in no way, anything in terms of negative view on the stock. It's just that we wanted to spread the risk around while maintaining exposure, and with a little bit more torque, I might add, with the company we reinvested into, also a gold producer, but smaller and with more operating leverage.
Got it. Okay, let's go to your third pick from last year of May 10th. Microsoft at the time was at $414.74 American, now at $449.98. 8% upside return and a 9% total return. It's been hit by a lot of the tech stocks, and maybe getting hit again today by the threat from Donald Trump to the Apple to build its phones in the U.S. But what's your forward look, sort of, on Microsoft specifically, and what at the time a year ago rung your bell about this one?
Well, it's just its dominance and its mission-critical nature for households and businesses. We like the cloud business, we like the more personal computing business, and we like some of the other segments, the hardware and gaming and so on. And we just think it's got an incredibly wide competitive moat around it. It's growing very quickly, particularly with Asia and their cloud business. We think they're taking market share. And so, yes, it's had some fits and starts along with the whole tech sector. But, this is one we just think is a globally dominant franchise. It's going to be very difficult to dislocate from that entrenched position that it occupies in households and businesses really anytime soon.
Got it. Okay, we're going to take a quick break, and Brian Madden's going to stick around to answer more of your questions. Stay tuned. Welcome back. Let's go to the phone lines. Elliot's holding on the line from Hamilton, Ontario. Hi, Elliot.
Good afternoon. The poster child for controversy. What are your thoughts on Alphabet? Thank you.
Thanks for the question.
Thank you.
Alphabet, I just did pull up. Let me pull it back up here. But Alphabet, of course, well, I mean, Google is controversial. They've got some cases going on in the U.S. What is your forward outlook on Alphabet?
Well, let me just say I'm glad it's Google that's the poster child for controversy and not you or I, Morella.
We like to stay out of trouble, yes.
Yeah, so this is a company that sometimes finds itself snared in the headlines in an unfavorable way. It's involved in some court cases in the U.S. We think they're probably going to prevail, but I will say that's not a legal opinion. Law and court cases are not necessarily our forte. Investment analysis is, and so to that end, I'll say, we own this company in our momentum mandate. We continue to like it and buy it. And what we like about it is it's obviously the dominant player in digital advertising through the search business. We also really like their cloud business, and we think they have also got a number of other things that they call other bets that, there's lots of them. Some of them might fizzle out, but some of them can pay off spectacularly. YouTube is another great content platform that continues to grow.
Because they're so known for their ads, and that's what the U.S. is trying to sort of break apart there. How do they do outside of that? How much of what they make is weighted in their ad revenue?
That's a big part of it. That's sort of 75% of their revenues and their profits.
So there's a real threat here to them.
Yeah, there is. But I think the multiple that investors place on the cloud business is higher, and justifiably so, even though it's a smaller part of their business, because it's less mature, it's growing faster. We're maybe in the middle innings of adoption of cloud hosting, and so, to the extent they continue to keep on sort of grinding out gains there, which they are, that should be good to see. The other thing is, there are some fears that things like ChatGPT and Perplexity could dislocate them in search, but what they're doing with, I believe it's Gemini, is their AI LLM. It's getting sort of wired into their search functionality in different ways that is adding value to search. And so, I think the behavior entrenchment in search is going to be difficult to dislocate. Remember, we use the word Google as a verb now, so that speaks to 20 or 25 years of habit-forming behavior on the part of consumers. So as long as they can keep investing in R&D and innovation and upping their game and being the best at search, we think they will remain the dominant player in search, notwithstanding efforts of other hyperscalers to try and dethrone them.
Got it. Okay, let's go back to the phone lines. Kevin has a question from Kingston, Ontario. Hi, Kevin.
Hi, good afternoon. Thank you for taking my call. It's on the TD Bank. I'm thinking of stepping in at this point. I've been dabbling in it, buying little bits here and there over the last several weeks. I'm wondering, has it topped out, or do you see more upside? The problems in the U.S., the penalty is behind them. They sold Charles Schwab the other day or a while back, and just wondering if you see more upside, and would you be a buyer at this $90, 90 and change price tag it's at? Thank you. Bye.
Okay, so they're at 93. They reported earnings this week. They did well, but they're cutting 2% of its workforce. So they're still in their transition.
Well, yeah, they are. So this is not going to be an immediate fix. But remember, the market is a forward-looking discounting mechanism. So, the clouds were darkest before their DOJ settlement and the executive transition, the new CEO, and so on and so forth. And that's, of course, when the shares are most deeply discounted. We own this. We continue to buy it. We were buying more so in December, when they reported their fourth quarter and transition plans for the CEO. I spent about 3 hours or more yesterday going with a fine-tooth comb over their second quarter earnings results. They were much better than expected. Interestingly, though, the biggest segment for them is their Canadian personal and commercial banking segment, and that one actually missed street expectations on soft volume growth, notably in mortgages. but they had handy and sizable outperformances from both their U.S. retail segment, which is now exclusively retail banking post the $21 billion divestiture of Charles Schwab, for which they booked a $9 billion gain. Also, strong outperformance in the wealth management unit and a very big quarter from their capital markets business as well. And then the other thing is they've got a first-class problem on their hands. They're the most overcapitalized bank in Canada. Their CET1 ratio is just under 15%. So they're going to be buying back a lot of stock. They did buy back $2.5 billion in the first quarter at what turns out to have been prescient timing and good prices relative to where we are today. They're planning another $5.5 billion worth of buybacks before the authorization expires early next year. They've scheduled an investor day to unveil the results of their strategic review under the fairly new CEO for September the 29th. We will likely attend that, all of which should help to rebuild investor confidence and restore the premium multiple the stock used to have to its big six peers. And all the while in the background, or really actually in the foreground, because it's a primary objective for the management team, they're working day and night really hard, spending a lot of money to remediate the anti-money laundering and governance deficiencies in the United States. That could be a long road. We are hopeful that they're going to get after it faster than, for instance, Wells Fargo, who's still sort of struggling with that consent decree they agreed to a few years ago. So unfortunate what happened to them, but water under the bridge, and we think the shares will go higher here.
Got it. Let's go squeeze in another phone call from Renata from Oakville with her question. Hi, Renata.
Hi, good afternoon. My question is on BCE, which I bought a while ago when the dividend was still double of what it is now. And if I sell it now, which I'm inclined to do, I have a major, major loss. But where do you see it going the next little while? Should I hang on, or how long will it take to even get close to where I bought it at? I'll hang up and look forward to your opinion. Thank you.
Yeah, so BCE went to $30 at one point. Now it's still back under 29, but has just staying dramatically. Parent company of this channel and under the Bell Media brand. What do you see forward looking for BCE?
Yeah, thank you for the question, Renata. And I want to draw the focus to one particular part of it, which is the particular part of the question, when will it come back to your costs? I'm going to suggest that
might not happen.
I'm going to suggest that you reframe the way you make investment decisions to discard what your cost base is, because that doesn't matter. That is water under the bridge. It is behaviorally and psychologically difficult to rip off a Band-Aid and admit that the initial decision perhaps was an error, and to realize the loss. But remember, the loss is real already. The stock has gone down in price. So what matters is where is it going forward, regardless of what your cost is. So from that perspective, yes, acknowledging the board and management team did make the difficult decision to for their part, rip off the Band-Aid and acknowledge that the dividend payout policy was unsustainable and cut the dividend 60%. That stings a lot if you bought it for income. The market was sort of getting ahead of that, and that's why the stock sold off so heavily in the last 2 or 3 years. We think the dividend policy is now sustainable, and our prognosis would be your total return expectation for this company is likely to be confined to more or less what the dividend yield is, which is to say we don't expect the shares to bounce back sharply in the short term. So we don't own it, and we wouldn't be buyers of it. And I would suggest, you possibly consider something with a better total shareholder return perspective, but with commensurate or similar risk, like TELUS, for instance, where the dividend is likely to grow, the yield is similar, and the total shareholder return prognosis is better.
Got it. Okay, Brian, we have to take another break. We're going to get some more phone calls lined up. We're back in a moment. Stay tuned. Welcome back, and thanks for joining us. John is on the line from Milford in Ontario with a question today for Brian Madden. Hi, John.
Hello. Brian, I would like your thoughts on National Bank going forward. I've owned it since I've owned it for $39 years ago. I've been in the market for well over 30 years, and most of three of my banks are well over $100. And it used to be a given; they used to be splitting after $100. What's your thoughts going forward? Thank you very much. Bye.
Great, thanks for the question, John. So a two-part question. The second part of it, I'll sort of tackle that first. So. You might see a split, but I would say the importance of splits is diminished. It started to diminish in the late 90s when the spreads on stocks went from nickel spreads to pennies, and in the U.S. from 8ths and 16ths to pennies. And now if you trade algorithmically, you can trade in fractional cents and so on. So the other thing is for small or new-ish investors, a recent innovation on the part of some of the discount brokerage platforms is you can actually own fractional shares of the company. So there's not as much to be gained from splitting a stock. So just setting that aside, what do we think of National Bank? We don't own it. We do own three banks. This one probably vies for our attention as well as any of the other three of the big six that we don't own, but we haven't pulled the trigger on it. It probably warrants a fresh look in the wake of its merger with Canadian Western Bank. I think that is a fantastic, really phenomenal, very synergistic deal that makes it legitimately and credibly a scale player nationally, and allows for some cross-selling opportunities and broader capabilities to some of the commercial banking clients and cross-selling wealth and various other things. Beyond that, capital markets business is excellent. They're reporting their results midweek next week. More than any of the other big six banks, this one indexes heavily to secondary market trading, so their capital markets business should put up good numbers in light of the frenetic trading activity and stocks, bonds, options in the second quarter. There's a small business in Cambodia that's been a bit tricky, but it's not big enough to really move the needle much. But this is a really good bank, so I think it's one you can continue to own comfortably.
Got it. Let's get to an email then. This is coming from Porter. He says, can I please have your thoughts on CP Kansas City, so the rail? Is it a good entry point? We'll pull up Kansas City and have a look at them. Trade's still going back and forth. There was concerns that they would be hit by all of the tariffs and a real slowdown in rail. They got hit in April like everybody else did, but they've climbed back up.
Yeah, so this actually just had an update from this company at a three-day industrials conference 2 weeks ago that my colleagues and I attended. Things seem to be going well for Kansas City Southern. It's always good to hear from the railroads, not only for the sake of informing yourself about that company specifically, but because they're such a bellwether on the goods and the manufacturing and really the broader economy. So a solid update. They were tracking volume growth in the mid-single digits in the first quarter. They've indicated that those volumes have accelerated in April and May. So again, another indication, as we spoke at the top of the hour, about the hard data coming in fine. So physical goods are moving. They noted strength in what they call their bulks. So that would be Canadian grain and fertilizers notably. They said autos were steady, which is comforting given tariff risk there. Obviously, they're getting after what's, I think, the better part of $1 billion in synergy opportunities between costs and revenue opportunities with the Kansas City integration. A key capability is the ability to do a straight shot down from the U.S. Midwest down into Mexico into the Port of Lazaro Cardenas post this merger. Shippers really like when you don't have to interline goods and move them from one line to another, so they have that capability. They also noted there is a partnership called Gemini, not to be confused with Google's artificial intelligence, but a joint venture between Hapag-Lloyd, which is a big ocean liner shipping company, and Maersk. And they think that coming together is going to help them drive more volume growth at both their Vancouver and Cardenas-Lazaro ports. So although we don't own this, we actually think in transportation there's more re-rating potential within trucking where there's overcapacity that in time will sort itself out. This is a through-the-cycle outperformer. It's had a 10-year compounded total shareholder return of 11%, the TSX 9. We think probably that can continue sustainably with about a 2% dividend yield and a high single-digit earnings growth rate. So no quarrel in owning it, but we think there's more torque and more re-rating potential in the trucking sector where we do have a position.
Got it. Okay, we do have to take another quick break, and that's all the time we have for phone calls. But Brian will share his top picks, his new ones, when we come back. Join us Monday for Market Call. Derek Warren on the show, Vice President, Portfolio Manager, Lincluden Investment Management. He'll take your questions on REITs on Monday. And if you miss Market Call, check out our daily podcast. You can find it on iHeartRadio and other platforms. And you can also watch full episodes on our YouTube channel. We're back in a moment. Stay tuned. Welcome back. Brian Madden is here to share his new top picks. His first one is Constellation Software on the TSX. What do you like about Constellation sort of down the line?
This is sort of a mysterious and opaque company, but one that is well held, well owned, and people hodl it, hold on for dear life, I suppose. And it's just been a massive compounder, generating a total shareholder return of 36,000% since the IPO, initial public offering in 2006. So the magic here, really, this is sort of like a software-focused private equity fund, but in a listed public company format. And essentially what they do is they acquire mission-critical vertical market software companies. And just to define that term, horizontal market software is something that you use across industries and niches like Excel or PowerPoint or Outlook. It's applicable to any industry. Vertical market software is narrow in scope, so it might be sort of an operating management system for a vet clinic or a daycare or a golf course or something like that. But you need it to run the business. And so the company goes out and makes small tuck-in acquisitions of usually founder-led, mom-and-pop vertical market software companies. They usually keep the incumbent management team, and they equip them with some operating efficiencies and procurement scale, but really give them autonomy to make decentralized decision makings and help them to grow. And they do hundreds of acquisitions every year. And they keep finding more because it's a very fragmented industry. And they've managed, despite operating in industries that most would acknowledge are sluggish, sort of low single-digit organic growth niches, to compound their earnings per share growth at a 24% pace over the last decade. The stock is richly valued. It always is. It trades at about 40 times earnings. But looking at this 24% historical and likely prospective earnings growth rate, we see a fair combination of value and growth here, and a track record that you really can't quarrel with.
Got it. Okay, let's get to your next top pick, which is Lennox. They do HVAC, heating, air conditioning systems, and I guess you're looking at this in the lens of climate change.
Yeah, I mean, you don't think about it on a chilly day in late May like today, but yes, this is secularly advantaged by climate change as once temperate regions become uncomfortably hot for longer and longer periods of time, requiring more powerful and bigger and just generally more air conditioning units. So they manufacture HVAC equipment, so that's heating and cooling. And they distribute it as well. They're a big player, mostly a domestic business in the United States, so you see them a little bit here. Manufacturing largely in the United States, some in Germany, firing up a new state-of-the-art manufacturing plant in Saltillo, Mexico. They've got a well-articulated plan to improve their operating margins by a few points over the coming few years. The other thing is, in the United States, a new environmental regulation came into effect just this year, phasing out the use of a refrigerant called R410A in cooling systems for something that's less greenhouse gas intensive. And so that is having favorable price and mix effects on their business. So, we see, with fairly conservative perspective, a good path, a visible path to a high single-digit or a low double-digit compounding of earnings in the coming years. And that should continue to support their 12% dividend growth cadence that they managed over the last decade.
Do want to get to your last pick, which is Bank of Montreal. We've got about a minute for that. But what do you like of Bank of Montreal compared to the other banks?
Yeah, so what we like about this, first of all, we like their footprint in the United States. Post the Bank of the West deal, they are the third biggest bank in Canada. They're one of the top 15 in the U.S. after this BOTW deal. We think they have a great Canadian wealth management business. They have a great North American capital markets business, a pretty good but smaller insurance business. We met with their executives late last year, and they articulated a pretty credible plan to drive their returns on equity back to the mid-teens from a recently more depressed level. And some of the initiatives to support that are better and more efficient use of their balance sheet. So the shares are trading about 1.3 times book value. We think there's scope for that multiple to re-rate higher as they get sort of the bulk of their credit loss provisioning behind them in this quarter or next quarter, or perhaps it's even already behind them, and earnings growth starts to reaccelerate.
Got it. Okay, we do have to leave it there with Brian Madden. Thanks for coming in, Brian. We hope you have a good weekend, and we hope you as well have a good weekend. We are going to leave it there. We'll see you back here on Monday. We'll take a look at the markets as we head to our break. Thanks for joining us.